we are at the verge of a financial crisis in the plumbing, as I showed you in the reverse repos. And because of the bank term funding program, especially if it closes, we're going to be in a combination of a highly inflationary environment with a financial crisis, which is going to force printing of ungodly amounts of money, even as consumer prices are continuing to rise. And what do you think happens to gold and silver in that scenario? We have a late 1970s, 1980 scenario. And I believe that will lead to the endgame sometime this year, maybe later in the year.
Renowned financial analyst Rafi Farber predicts that the current gold and silver scenario resembles the late 1970s, resulting in an endgame later this year. Gold is poised for an upward trajectory in 2024 as investors pivot towards the precious metal amidst geopolitical concerns and a weakening U.S. dollar. Experts from ING Think predict a rise in gold prices, propelled by heightened global uncertainty, a slightly weaker dollar, and potential interest rate cuts by the U.S. Federal Reserve. Rafi Farber sees the steady rise as a sign of stable money and hints at silver's potential remonetization in the endgame. The Coinage Act of 1873, known as the crime of 1,873 inches by silver advocates, effectively demonetized silver, a currency used since the founding of the United States. This led to a reduction in the money supply and contributed to deflation. Analysts predict a strengthening in industrial demand to bolster silver prices, setting a target of about $26 by mid-2024. Influential factors, including reduced interest rates, stronger physical investment, and rising industrial demand, are anticipated to constrict market conditions. Rafi raises concerns as a Fed official hints at ending March's emergency lending program, responding to Silicon Valley Bank's failure and fallout from Fed rate hikes. After the collapse of Silicon Valley Bank and Signature Bank, the Fed created the BTFP, allowing banks to easily access capital to help assure banks have the ability to meet the needs of all their depositors. Moreover, he points out a major issue without an extension. Banks repaying $500 billion in BTFP loans by March 2024 would significantly shrink the Fed's balance sheet. Curiously, late last year, some banks started to ramp up their borrowing from the BTFP once more. In the past 6 weeks, the amount borrowed from it has jumped to $141 billion. Now, we present the clips of Rafi Farber's insights from his recent video with Arcadia Economics. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
I'm going to begin on a simple technical note here. I'm not sure what has happened by the time you're watching this, but silver is dancing across the 200-week moving average here. The red line, which has been bouncing off and through and off again. This red line, the 200-week moving average, has been actually remarkably stable, going up at a steady pace for at least the last 2.5 years. We see from 2021, it was somewhere around, it was about $19 in 2021, and now it is at $23. So despite all this volatility, which is typical in silver, the 200-week moving average has been moving up pretty steadily, and that is a sign of stable money. Though, of course, silver has not yet been remonetized, but it will in the end game, if only briefly, which is when you're going to have to spend your stacks, which is pretty much my mantra these days. A top Fed official on Tuesday signaled that an emergency lending program set up to counter the fallout from the failure of Silicon Valley Bank, really to counter the fallout from the Fed's raising interest rates, would likely wind down as scheduled in mid-March. Michael Barr, the Fed's vice chairman for banking supervision, suggested the bank term funding program would not be extended. And so what happens then? What happens if this wonderful program is not extended beyond March? Well, I'll show you a very simple graph, which will show us the magnitude of what is being suggested here. We've all seen this before. This is the Fed's balance sheet. Here's the apocalypse, September 2019, going up a little bit. And here's the COVID lockdown insanity. And we went pretty much vertical here. And then we were slowly moving up and up and up until around the end of the middle of 2022. And we're starting to do QT. Oh, here's the first problem. Look at that. Just after a little bit of QT, you have this is the BTFP. This is the effect on the balance sheet. What happens is the Fed takes in these underwater bonds onto its balance sheet. Its balance sheet rises, and the banks that took advantage of this, that gave the Fed these assets, represented by this bump here from 8.34 trillion to 8.73 trillion. So what's that, like $400 billion or something? What's 8.3? Quick math, 8.3 to 8.7. Yeah. $400 billion at least. It's going to be more than that because remember, this is fighting the other QTs and other sectors of the Fed's balance sheet. So let's say, I don't know, like $500 billion, something around $500 billion. That is the bank term funding program. I could go into the exact chart, but whatever. Let's just estimate it. If we're off by 100 billion, who really cares? So if this program gets shut down in March and they are 1 year loans for face value of underwater bonds, so what happens is that the banks that took these bonds between the dates of March 8th, 2023 and March 22, 2023, they have to pay those loans back by March 8th, 2024 and March 22, 2024 because it's a 1 year loan. So in March, these banks, if the program is not extended, are going to have to pay back $500 billion in loans and shrink the Fed's balance sheet. When you pay money to the Fed, right? When you pay back a Fed loan, the money, the dollars goes to the Fed. The dollars go to the Fed, and then the Fed takes those dollars out of existence. So if the BTFP is not extended, that is the effect of the equivalent of QT of about $500 billion by March 22nd. Is the financial plumbing going to be able to take that? I don't think so. So I'm pretty sure the BTFP, one way or another, is going to be extended.
Rafi Farber underscores the challenge for the Fed to reach its 2% CPI target, foreseeing a new wave of consumer price inflation. U.S. Federal Reserve officials took little fresh signal from consumer price data published on Thursday, as they gauged whether inflation was headed firmly enough back to the central bank's 2% target to allow them to reduce interest rates in coming months. Overall, consumer price inflation on a 12-month basis rose to 3.4% in December, from 3.1% the month before. But, excluding volatile food and energy costs, the pace of price increases fell to 3.9% from 4%, showing ongoing moderation in underlying price pressures. Furthermore, he voices concern about an impending financial crisis due to reverse repos and potential problems with the bank term funding program. Let's get back to the interview.
I wanted to go into the CPI, into the Consumer Price Index, because something is happening with owner's equivalent rent and shelter, which is keeping the CPI elevated, which means that the Fed is not going to reach its target of 2%. We have here owner's equivalent rent at 6.7%. This is the biggest component of the CPI by far, but 6.68%, actually 6.68%. If we look all the way back to the history of the owner's equivalent rent index, it has never been this high except for, here was the previous high in April 1986 at 6.65%. We're now at 6.68%, and yet we were higher over here. So with the exception of this brief period over here, which we just experienced, the owner's equivalent rent index has never been higher. And if we move to a different version of this graph, if we change to a percent change view of this graph, we see that the percent change from last month is about 0.5%. And we've never really been that high either since around 1990. So this index is headed higher, and so is the CPI. There is no way that the Fed is going to reach its target of 2% on the CPI, and we are headed towards a new round of consumer price inflation, which will make rate cuts very, very difficult. But they will have to happen anyway because we are at the verge of a financial crisis in the plumbing, as I showed you in the reverse repos, and because of the bank term funding program, especially if it closes, we're going to be in a combination of a highly inflationary environment with a financial crisis, which is going to force printing of ungodly amounts of money, even as consumer prices are continuing to rise. And what do you think happens to gold and silver in that scenario? We have a late 1970s, 1980 scenario. And I believe that will lead to the endgame sometime this year, maybe later in the year.
The outlook for precious metals suggests a potential upward trajectory. analysts and experts often cite various factors, such as economic uncertainties, inflation concerns, and historical patterns, that contribute to the optimism surrounding the rise in gold and silver prices. What steps do you believe investors should take to safeguard their financial interests following the uncertainties in the current economy? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.